Hi. Right, a quick update on everything. First thing that I think is important is that copper gold has definitely broken back up. It led the bonds down in price and up in yield, and now I think it's decisively broken this area of trading, and it's leading back down. I don't think this is going to change for quite some time. I think the bonds have seen their top in yields. I'll examine that. But to me, this is significant. This is something that's going to prop up bonds for several weeks and months. So I just wanted you to be aware of it, and that is going to color my opinion for the next few weeks. Secondly, what seems to be happening is that basically SPY TLT is stuck, but it's stuck with a moving average that it's coming down. To me, this is pretty much a top of in oops, can't do that. Let's have a look. Pretty much a top in SPY TLT. You can see how the very long-term moving average is now keeling over. I really don't expect SPY TLT to go up there and start making new highs. That would basically mean that if bonds are stable or stable-ish, that would mean a big rally in SPY, and basically the market saying that no, we're going to have no recession. I think it's early for that. Okay, so since it's early for that, I can't see SPY TLT breaking out of this range, or when bad data comes in, I can see it testing the downside. So I can't really be all that positive on equities unless I'm hugely positive on bonds. And I will now show you the triggers which would make me hugely positive in bonds, but I doubt that we will trigger them. Every other indicator I look at, whether it's SPY over IEF, it's saying the same thing. This is a retracement. Okay, it's not a change in trend. The moving averages in all of them are turning over down to the downside. Even if I look at the equal weight, I mean, what's it done last week? Nothing. This is so equal weight consumer staples over consumer discretionary. It hasn't really done anything to change, to say that the trend is changing. Is just, trading around and correcting. SPY over XLY, it's just coming down to, from very overbought regions, it comes down here and then goes again. So all the risk indicators are basically saying that we are in a correction phase, but not in a change of trend phase. There's absolutely nothing that says that. If we look at the tech spreads, I mean, this is the one that I like, and this is NDX over INX. NDX basically got to the 200-week moving average and this very important support that we had from COVID, March of 2020, and basically is just correcting, but it's correcting into these moving averages up there. So yes, NDX can do a little bit better compared to INX, get to 320 from 309, so that's what, another 2-3%. But that is what you're looking at. You're looking for moves of 2-3% relative to each other, and that is because I don't think the bonds are going to go anywhere. And I will show you the levels in bonds now. Okay, this is the daily 5s, 30s, and basically try to take out the top into the negatives, and all it's done basically is retraced a little bit. So the pressure has come off the belly, which is what I always say, don't trade the belly when there's a retracement, because you'll get wiped out. So all it's doing really is coming back to the moving averages. This is not a change in trend. It'll bugger around here and then it'll go again. So it's just a little bit of pressure coming off the bonds. If we have a look at it on the weeklies, same thing. We'll go to something like, what is this? This is like 20 basis points. Yeah, so it'll go to 20 basis points and then it'll go again. It's just very minor moves. This is not a change in trend. This is nothing really like that. And now if we look at the individuals, you see the fives. Okay, where can I get bullish the fives? I can get bullish, really bullish the fives, only below 267, 268. For me, fives are now stuck in a 3% to 350 range. Okay, that is what they're going to do. And I think we have the ideal position, basically being long of 112 puts, having got rid of the futures that we bought right at the top. And I think we will now trade 305. Not unless it takes out this point, 268, can I start getting bullish of the fives. It'll all be just trading. Tens. Where can I get bullish of tens? I can get bullish of tens if it takes out 273, 274. It's not going to do that. Why would it do that? The Fed is still tightening. You can see how my 324 on a closing basis always got respected. Why can't we do something like this? Okay, can we even go like this area and trade many weeks in this kind of area? Absolutely, but only below 274 can I get really bullish, and that is just not going to happen in my view. It might get towards it because copper gold is leading it, so I think all the pressure eventually is going to be for us to go there. But in the meantime, any dip you base to 324, you buy it, or you buy calls on it, looking for it to come back down towards this area. And the 30s, I can only get bullish on 30s below 294. I think we could get there, but every time it goes up here in this something like 335 to 340, you buy calls and you look for it to go down towards the 3% area. I mean, look how many weeks and weeks and weeks and weeks we spent up here. Why should we're not going to just boom go down to 271. It's just unlikely to happen. What kind of data would we need for that to happen during QT? It is very unlikely that is what is going to happen. It's much more likely that we get smaller moves, and these are weekly charts, don't forget, and we get lower volatility within a range. To me, bonds have topped out for the next 3 months and will trade down towards this 3 area. But it's going to take time, and it's going to take a little bit of volatility. But on the other hand, you just keep on buying the dip in bonds, buying some calls, and you look for it, you look to make 4 or 5 points, something like that. The patterns are very similar in Europe as well. Okay, so I think that this is likely to turn into an ABC. And so basically you're looking for around 165, 168, and then you are looking for it to come back down to 142. This is the Bund. If you look at the French market, which is the one that's been absolutely, on the chart spot on, you look for something like this, 230, and then you look for this area here, 168, 169, which will trade. Basically a nice ABC, and then it just trades around. I would have thought that at some stage you even see this 155, 154, but that is all you're going to get. If we look at the other bits of Germany, oops, I didn't do this chart. This is the twos. So let's have a look. Twos, Germany, Schatz, close. Let's open that up. You can see that the pressure has basically come off this chart. Oops, why is it doing this? Excuse me just a second. So here it is. Why is it doing this? So basically, I think we return here 101, something like that, and then we come all the way back down to, you know, A, B, C, something like 48, 49. So basically, we are in a period where we are consolidating these massive gains from all these uptrends, and really, I mean, let's do this game here. If we say that we started the big move here, and let's do this one. So if we started the big move here, and we topped out there, look at that. You know, 0.382 retracement is exactly at the line. So 142. So you're looking for it to come back up and then down to 142. 142 is really going to be the very, very important level in bunds. So that is, we are 152, so that's 10 basis points here. And if we go and look at 10 basis points on where the 10s are in the US, we are at 312. Well, that takes us down to 3%, maybe slightly lower than 3%, which is right in that area that I told you where I think that the 10s are going to bottom out, which is around 298. So that is it, I think, for the next couple of weeks, and certainly while I'm away, and I'm coming back next Monday. You could, so basically a week, that is all you're away. I would say that anything around 320 in the 10s and anything like here, 165, it's worthwhile playing for a move down towards this 140, 142. Given the fact that I showed you that basically SPX and bonds are still tied together, what would that imply? Well, that would imply that at some stage we rally back up. You know, basically, this is a weekly chart, so can we do an A, B, C on a weekly or the dailies and get up to this kind of level, 4,060, 70? Absolutely, but to me this is going to be as much as equities can do without a further move in bonds, and to me we're not going to get it. We're only going to get another 10, 15, 20 basis points out of the bonds max, and therefore 4,070 is the level that I think, you know, 4,050 to 60, 70, who cares? That is all you're going to get, and that is not even 100 points from here, right? And if we look at NQ, really, what I would love to see is this level here, 12,800 to 13,100, because that is the area that I think risk reward is massive, again, to the downside, to fill some of these gaps. So 12,400, can we test it? Absolutely. You know, do we break it? Who knows? But this 12,700, 800 area, I think when we're there, if you buy 12,700 to, let's call this 11,500 put spreads, 1x2s, I think you'll make money. So that is basically my view. We do a little bit worse in bonds, then a little bit better. And you know, let's take give you the 30s again. I think anything around the 340 area you want to buy for, you know, a move back down towards 320 and eventually 3. But that is all you're going to get. That's a 25, 30 basis point move in 30s from here, which could support the equities a bit more than we've seen. but I don't think we move a million miles away from 294. If we see 294, it'll go back to 320. That's why I took my position off at 138, because I thought, well, we're as good as we're going to get. It proved right. We're going to be in that kind of range. The other reason why I think that bonds are going to do not much more than 15, 20 basis points either way is the commodities chart. This is DBC against gold, and as you can see, it's going back to what I would call fairish value at my line. And what this is telling me is that we're not going to move a million miles away from here. But what it's telling me is that gold has got more or less the same performance as DBC, but with less volatility. So volatility adjusted, it seems to be better to hold gold than DBC. And if we have a look at a weekly chart of DBC, basically this formation tells me that we're in a consolidation phase for many weeks. Okay, and that everyone who thinks that oil is absolutely going to shoot to the upside, it's unlikely to happen. And a consolidation in oil tells me that it's a consolidation in inflation expectations, which tells me it's a consolidation in fixed income, with some of the excessive thoughts about, oh my God, the Fed is going to go 1% because we're going to have huge inflation. That is going away. That is being taken out. And that is why I think overall fixed income will do slightly better. And, you wait for the dip and you buy some calls in fixed income. I think that is probably even safer than buying them in equities. Last thing I wanted to show you is that I think DXY has topped for a bit, and DXY has been taking all the oxygen out of the room when it's going up, and risk can't do much better. And even the relationship of the European bonds to the US bonds, I think it trades 103 over the course of these 102.82. Or even down towards 102. And as that happens, it basically normalizes the curves. The pressure goes off the interest rates, and bonds can trade a little bit better. And that props up equities as well. So we're talking about a period of of a few weeks, and certainly this week that we're in, that I think that you buy the dip in European bonds, you buy the dip in US bonds, and you look for those levels that I was talking about, and I'll go back to them, from 340 down towards, this kind of area, 305, 306, 307, and in the tens, you go, you're looking for these kind of levels, 288, 290, 291, something like that, just exceeding the highs of last week. You buy that dip, you look for it down there. Okay, very best of luck to you all.